Is there a more efficient way to create a perpetual income stream?
That's a good question.
Because I come from a background where it's a battle. People will say, no, 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 keep the money, invest it in the market, and as if the market is some like thing. Keep the money in mutual funds and stocks and things like that, in hopes that it grows, it appreciates faster than you can pull the money out of it. So that the appreciation is faster for a long enough period of time, and you have a big enough scale or volume of capital that you pulling out $25, $50, $100,000 a year, you can't deplete the pile.
Hello and welcome to the Durham Talents channel. My name is Jesse Durham. For today, we're back for a part 2 on annuities with my buddy Joe DeFazio. So we'll recap where we were part 1. If you haven't seen that video, I would encourage you to check out where we are beginning to discuss annuities. And we're going to do it in a context of implementing infinite banking as well, connecting those dots. And I hope that you enjoy. Awesome. All right, so this is going to help me, Joe, because I've known some things from our last conversation and I learned some things from our last conversation. So I would like to recap. Yes, cheers to you too, sir. I have my adult beverage as well. It's called coffee.
I'm on decaf. I'm not that crazy just yet. Too early.
Mine's caffeinated. I even have some creamer in there because I believe in abundance. I come from the land of milk and honey, so that's how you know it's good. A little biblical reference for you there. But yeah, let's do that. Let's recap where we were in annuities, and then I'm going to let you go wherever you want to go. And I do have questions that I want to both elaborate on or just branch into that we didn't get to cover last time. And I know you want to do the same. So an annuity is a contract from an insurance company, which essentially allows it to be a private pension. So that helped me when you said that, private pension. It's like a private pension to somebody. And there's this deferral stage, and then there's this annuitization stage of the annuity. And deferral is where the individual is deciding in their contract, okay, yeah, maybe I don't need the income right now to be paying to me. Maybe I'm going to be paying in with either a lump sum or some ongoing premiums, because they are premiums, right? I'm using the correct verbiage here because we're talking about insurance companies. So perhaps that will be a one-time premium, or perhaps there will be some ongoing premiums during that deferral stage. But once you're in that annuitization stage, that's when the individual is receiving that pension type income from the insurance company. I do want to return to characteristics, talk about characteristics of annuities. And then in that annuitization phase where an individual is receiving steady income, it could be a variable income or a fixed income, depending on which type of annuity. So there are several types of annuities. And some of those, the professional might even need to be licensed in a particular area, we said, if there's a connection to the market, like with an indexed. And we didn't go real deep into the types of annuities, but we did talk about fixed and we did talk about indexed, variable, sub-accounts. We covered that stuff last time. But the income for the individual could be variable or fixed. And insurance companies in general would like to see an individual take 30 or 40% of whatever their net worth is to apply towards diversifying. I guess it would be a very common term, right, that people would use in the conventional financial world. 30 to 40% of whatever their net worth may be would be appropriate, they would say, for annuities. In that deferral stage, you can get a distribution from your annuity. Terms and conditions apply, right? Again, at the end of the day, these are contracts. Everybody should be familiar with their contract or their potential contract before they have it and while they have it, of course. But once you're in that annuitization stage, it's a one-way street after that. It's set. You're either going to be getting a fixed income or a variable income, depending on what you had, but it is a one-way street. You could have a single or joint annuitants. You you have different roles. Someone's an annuitant, someone's an owner. We talked about there aren't the same steps in the application, let's say, because there's not a medical, because it's much more about net worth and not so much about someone's health when evaluating for a life insurance policy. There is a beneficiary option. Death benefit is taxable. You can have a return of premium. That was an option that we mentioned. That's interesting. We talked about whether an annuity is an investment, and we said no and yes. No, because it's not necessarily an investment. It could just be a contract where you pay this, you receive that, and it's done. But also, if there's some tie to the market because of the type of annuity that it is, then it could be experiencing investment-like fluctuations. Still so far so good? Okay, you're nodding your head, so I'm going to keep going. One other thing was that you could do a 1035 exchange from a life insurance policy to an annuity, or from one type of annuity to another type of annuity, or long-term care. Right, so much like there's this 1031 exchange in real estate, in the insurance world, there's this 1035 exchange where certain exchanges can be made and others cannot be made. You can't take an annuity and exchange that for a life insurance policy, but you can take a life insurance policy and exchange it for an annuity, or an annuity for another type of annuity, or long-term care. And then one other thing, and then I'll leave it to you, is you did mention, Nelson, because we are going to just be talking about annuities, right? The entity itself, standalone entity, right? Standalone contract, or this is what I hope we will. And then I also want to have some connections where we're talking about the implementation of infinite banking, of course. And you said that Nelson had a particular view about annuities and other things. So that's me prefacing this second conversation with recapping our prior conversation. How did I do?
Wonderful. I want to clean up just a little bit of my language for the folks. For example, I called it deferral. There's deferred, and like, let's call the phases are accumulation and annuitization. They're just
Thank you.
industry jargon, but I want to clean that up. Annuitization is when he's saying we have the income, right? The one-way street. The accumulation is that two-way street. But just so you're aware, it's the jargon. We can keep calling it deferral if that's easier, but it's one feels like an account, and one is no longer an account, it's an income stream. We've made that permanent exchange to an income stream. Thank you for calling it, we're paying premiums. It is a life insurance, it is an insurance contract. So it's not like a bank account. It really isn't. It's not like an investment account. There are repercussions for taking distributions at different phases of that deferral or accumulation phase, which adjust the benefits that you agreed to in the original contract.
Much like, let me interject then, for people that are very familiar with us talking about infinite banking, that would be much similar to someone, say, paying an extra PUA premium into their policy. Of course, that then is going to change the death benefit, the cash value that'll be accessible, future dividends that they may earn, right? Because there was a change at this side, so it created this change back here.
Yeah, and yes, that's a great example. Whether it's you paying in additional premium, or if you actually withdraw the premium and convert it to cash, that'll change those values as well. During the annuitization phase, let's just call them income plans. It's a little easier for people to like, you've traded this part of the contract and we said we want an income plan, whether it's level, fixed, or fluctuating, variable. The one thing I think you said, maybe I missaid it in the last one, that you need certain licensure to sell these products. Your advisor needs to be licensed. They do not need any additional licensing for fixed annuities, including indexed annuities. You need the additional licensing for variable annuities. So I just wanted to clear that up for anyone. And it was the threshold of that 30 to 40%. It varies, but it's that's the top end to your threshold. Like, your compliance department's not going to like seeing 95% of your net worth paid as premium.
And again, if I could connect a dot right there to the insurance world, because these are the same companies that are typically offering these products, so obviously they have a lot of things similar in evaluating, well, how much premium is this individual looking to pay? What does that represent from their annual cash flow or their net worth, let's say, into this life insurance policy? They have parameters and rules of thumb there, of course, too. They don't want somebody to take 95% of their income and be trying to pay that as premium in policies. That's not what insurance companies are looking for or want or will allow even. So, which is always interesting, as you know, people would know that Nelson eventually says that someone should arrive at premium equaling income. But from the insurance company's perspective, I was just trying to say it's very similar, obviously, in how they're treating the premiums that they want individuals to be able to pay, and they have these parameters and percentages for life insurance policies like for annuities. So 30 to 40% on the top end. I got you.
Love it. And just to, I want to clear up something with that. That's a really good point with Nelson. He's not telling people to go out there and break the rules here. That wasn't what his intent was. His intent was, if you're following the process of banking, then the logical conclusion is, just like today, all of your money is deposited in a bank, just like today. Well, the goal is to get 100% of everything we're financing through a different type of banking relationship via whole life insurance. Well, then the natural conclusion is all the money that was going there should go here, which is 100% of your income. So I would say it's very different for someone buying a policy, never touching it, never using it, sticking it on a shelf. You please don't use more than, like, you probably shouldn't even put 30% here. There'd be really extreme situations to put 30 or 40% of your assets or income into that. If you're doing this with the intent of banking, and that's the end goal of the financing mechanisms here, then there's a very strong argument to increase beyond that 30% threshold. So just he wasn't telling you to break the rules. I think it comes with a little bit of nuance there of what he was saying.
Yep. And I'll add one more line and then we'll go back to annuities particularly. There are two different scenarios between, say, someone who earns $50,000 a year and is seeking to pay $50,000 in premium versus someone who earns $50,000 a year and they can have $50,000 pass through a system of policies that they own in some form or fashion, which might be base premium, PUA premium, loan repayments, etc.
Yes, beautiful. And I think in the earlier part of the transition, that differentiation is really important. Almost everyone can do that second example, right, where you can flow through the policy. It gets real hard later in life to get to the point where you can pay 100% base premium or 100% premium for the rest of your life. That's not an easy thing to do. But almost everyone can do the first part and get on that track where they're migrating toward 100%. Yeah, great point. Great differentiating.
I love it. I love this tangent. It's very relevant, I think, and I know that the audience will appreciate it. I even talk in the context sometimes of using that as one metric for people that are considering an amount of premium. Is just ask yourself, just so that you're aware, well, what amount of premium am I considering paying? And what does that represent as a percentage from my gross cash flow? Are we talking about 2%? Are we talking about 22%? Because that's a big difference. And so even for somebody that's considering a first policy because they want to get to infinite banking, I just think it's good to pin it to a metric. That way people are aware. Yeah, what percentage does this represent from my gross cash flow? Because like you said, and to your point, and to say it in a different way maybe, or another way, all of our money does flow through a commercial bank. All of it, 100% of it. So then when you put a metric to, well, what amount am I considering paying as premium into a policy? Is it 2% or 22%? Those are very different. So awesome. Anything else for you there?
The only thing I can recall from our last conversation, I think we ended maybe close to, or maybe I had this thought in mind, talking about mech. Why isn't mech limits like why is there a much larger, much more flexible contribution or premium threshold for annuities compared to life insurance? Like if these are kind of mirror image, we're exploring how they're mirror images, they use the same actuarial science. They're just taking the opposite ends of the science. Why would the IRS and government and the powers that be put these really tight constraints on life insurance that really aren't there on annuities? Now there might be company limits like, hey, Jesse, we don't feel comfortable with more than $10 million of an annuity with you. Um, but in terms of upper limits in 1 year contributions or sorry, premiums, or you can only put so much in over a 7 year period with these weird calculations that doesn't exist. Why? I think that's a cool, maybe if we get there, that would be a cool tangent to talk about. And we were kind of discussing distribution. Like, okay, once we're in that annuitization phase, or we'll call it the income plan, where we're starting to get this income, what could we do, or what problem is that solving that I can't already solve with my IRA, with my investments? Why do an annuity? That type of question. I think those are cool avenues to go down.
All right, good. So there were questions, and I didn't cover them in my recap because I was just trying to recap. We did have about 3 questions at the end of the last conversation. All right, so start with the mech one then, please. Why is it different?
Yeah, so you'd have to go back and look into where the uh, I guess motivation for these laws came about, and what happened coincidentally at the confluence of events were life insurance being borderline attacked for maybe saying there's too many fees, or it's behind this, we can't figure out what's going on in this black box contract. It's like magic happening. And I feel like the cash value is not growing fast enough. So we need to pierce that veil. That was kind of like one part of the argument. And then several years later, ironically, they take the opposite argument and say, whoa, 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 people are putting too much money into this thing. It's growing too fast. We can't keep up with it with our little mutual funds and ETFs and stocks. You've got to slow it down. And you get the language I'm using, you can kind of see where they put this relationship in place to say you can't put too much in because you can't have too much of a good thing. And we can't, it's like it's not growing fast enough, and yet it's growing too fast that it's
Now, who is this infamous they that you are referring to, Mr. Joe DeFazio?
so we don't know exactly. And I suspect it comes back to banks, ironically, not ironically. But I think banks instigating this fight among investment and insurance. The investment space was, hey, you don't need all that. Just buy a little bit of term insurance and put out the rest of it in a mutual fund. You'll be fine. Buy term and invest the difference. Spend cash, buy term, invest the difference. Whatever their slogan was. That was one area that was coming in here full force. I forget the gentleman's name who, um, yeah, I forget most of the history um, in terms of the characters' names, but totally falsified a lot of the problems that he highlighted with the whole life. Um, Most of them didn't exist. Most of them were him being bitter that his father bought whole life, and now seeing that term was so cheap. If he had used the same money to buy term, he would have had like a bajillion dollars more in death benefit for the family. So obviously there must be foul play. Um, and we're going down a little bit of a tangent here, but
Maybe. I mean, you're making me think of Art Williams. Is that
yeah,
is that?
yeah.
I mean, that's one individual anyway that had a strong voice around the subject. Yep.
Um, and that argument, that's an argument still today that people would say, why would I buy that whole life? Why would I pay, like, as if they are the same thing, whole life versus term. And like, you could do a very simple example. Go to your favorite quote site or agent and say, can I have a quote for a 5-year term, a 1-year term? And then go ask for a 5-year term and a 10 and a 20 and a 30 if they'll give it to you a 40-year term. And watch what happens to the premium. Is this guy bad? Is this guy evil? Is he trying to, like, what they're covering is a risk over a defined period of time. Whole life covers the risk over your whole life. If you pick a term, it's temporary. So you're only addressing the risk in the term you have defined. The reason it's so cheap is because the probability of you guessing your own death in that time, it's non-existent. It's a 1-2%, maybe being generous 2% of the time they'd have to pay out a death benefit. It's pure profit for the insurance company. In fact, it's a lot like leveling the mortality cost over the course of your entire life. For whole life, what you're doing is you're averaging out your mortality cost. That's why you pay more in the beginning than a term. But if you actually take the term and say, show me the ledger after the term expires, as if I have to renew each year. Show me what happens in year 21 through until I'm age 85. And the term starts out level maybe, and then it goes to the moon. To the point where late in life, you will pay dollar for dollar for the death benefit. Like, that's what it's approaching. So if you compare that total cost compared to the whole life, all of a sudden, which one's cheaper again? Which one can we actually pay for the 90-year until we're age 90? Whole life. So if we look at the entire picture, it tells a very different story. Well, anyway, I'm going down. Like, that's the mech, the people that tried to get this, that lobbied to get this in place, to put this cage around this terrible, terrible product that is whole life, that seemingly before that grew too fast, was too tax advantaged, was too like all these too abundant. We need to calm that down.
I'll go ahead and say one thing: the government didn't like that.
Yeah. And yeah, I guess we could say that the government didn't like that.
You didn't have to say anything. I said that.
Okay. Yeah, I think it was more anybody that doesn't like. So if you understand what you can do from a banking perspective, was one of these policies, you attain financial freedom. And not the type of freedom where you need a big pile of money that's depreciating in value. We call it inflation, but it's deteriorating. It's like it's fine. It's permanent financial freedom that you never need to ask anyone for anything ever again, and you're 100% private. They like that. You're not controllable in that state. So is there? This is why I say: could there be banks involved? Could there be other cloak and dagger behind the scene people that want that control still? Yeah, I would say if you have that much control and all of a sudden people are realizing they don't need you, they will not follow your rules anymore. They will not pump money into these investment companies called mutual funds, making them extremely wealthy. They won't do the things that are against their own interests. They'll do the things for their interests and their family's interest and their communities. So anyone that loses in that, anyone that's in odds with that, would be in favor of saying, well, let's clamp down on this thing. Let's not let people do that. We need to keep them over here in this other bank, keep them chasing this rate of return, keep them obsessed with time, obsessed with rate. And that kind of gets, I'll segue, we'll get off the mech thing for just a second, but the annuity doesn't suffer that. It's very interesting. If this is the mirror image, why wouldn't the annuity be subject to the same, like you can't put more than X% in there? And I think because you can't really bank with an annuity. All the other provisions of the contract, even, did you know a life insurance contract can be annuitized? Even the proceeds, the death proceeds, if you go to the insurance company and say, I don't want the lump sum, I don't trust myself, could you give me an income stream? They'll give you an income plan. They're like, if you pay attention to the contract line, it's very much like the mirror image. Yet there's no loan provision on an annuity. And the death benefit is taxable. It's not income tax free. So I think because there's enough holes in the annuity, they don't care. They know that they'll collect the tax revenue that they want off of it. You can't take money out and then put money back in, just like your IRA. You can't collateralize your IRA or your 401k. You can't, even a Roth. Now, you can take what they call a loan, but what you're taking is like a qualified distribution, a very special type of distribution. If you're employed and you ask your HR and your TPA to give you a loan up to $50,000 from your 401k or Roth, they will give that to you, but you'll see your balance go down. It's not the same thing. They just took the money out of yours and gave it back to you and said, you owe it back to yourself plus 5% interest after tax. You're paying tax twice if it's a pretext. So it gets a little like, they try to mimic this because that's what people love it. They love the flexibility of, wait, every dollar, once it quote unquote seasons or vested or all the premium is reflected in the cash value, I could just access it and put it back, and just like a savings account. No one's asking any questions. Even the growth, I'm not even taxed on the growth, like quote unquote growth, as it increases more than the premium I paid in. No one asks any questions. They just send me the money. It's completely liberating. You can't get that in anything else. Not with the degree of certainty and flexibility and simplicity of a life insurance policy. You just can't. The annuity doesn't have that part of the contract. Just like you can't. I haven't found anywhere that will collateralize an annuity. There's no loan provision within the annuity, but I don't even know a bank that would say, yeah, we'll include that and we'll give you 95% of that value so you can go do what you want to do. So I think because it's missing that degree of flexibility, as you said, cash flow flowing through the pot, like you can't do that with an annuity. They just left it alone. Just like, 401ks, or they have they have like $70,000 a year you could potentially put into a 401k. Independent of any other metric. Like, it's not related to your age, it's not related to your income, it's just everyone could put $70,000 in. So I think because it falls under the IRS's purview, where they're like, we know we're going to get a bunch of that back, we don't care. It's like, whereas this is like, wait a minute, it's tax advantage death benefit. There's tax advantage ways to access it. There's free reign on how you access it. We gotta not let people put too much into this too quickly, because at one point, very wealthy people were, and what they noticed early on was an arbitrage. That's what drew wealthy people to it. The crediting, like how much the contract was appreciating in value compared to the loan interest that the insurance companies were charging, it made it a no-brainer. So they would come and put, here's $1 million. I don't want to make another premium payment. Just let that thing grow, and I'll just use it as I need to. I think that drew so much attention. That's why when the IRS realized that when you connect all of those dots together, it's like, that's a huge hole in our plan to control you and to tax every dollar. Nelson called it Willie Sutton's law. That's why we have this status lingering in the background, ever present. It's always testing your policies. Now, most companies do a great job of avoiding it, and your advisors will do a great job avoiding it. But it's not like you make one little mistake and it's all over. But it's there, um, because things grew too quick. Things appreciated too quick. It was too tax advantaged. It was too liquid. It was too accessible. It was too, and realistically, no retirement plan or anything else, including an annuity, could keep up with it. Um, wow, that was quite the tangent. My apologies.
No, it's fine. It was too advantageous for the private individual. Well, what I always do encourage people to consider is history, reading. You know, I can't help but hear, you know, and it's in Nelson's voice in my mind where I've heard him say things along the lines of, well, the powers that be, right? What banks, government, and then I think about his recommended readings, right? Like how he's quoting Frederick Bastiat from The Law, even in his Becoming Your Own Banker book. And then I'm also thinking about, I would recommend to people, and I'd love to get your recommendations, Joe, anybody who's not read How Privatized Banking Really Works, for one example, I think would be a great one. So let me ask that question now while I'm there. Any recommended readings, you know, on the history of this stuff, or more perspective on it, like, you know, How Privatized Banking Really Works, for example? Anything else?
Yeah, I think so. One, let's differentiate. If you're trying to learn more about what it means to bank, I think the first place you got to go is becoming your own banker. I think that's the genesis of a lot of this. So, and man, I privately in private groups, I share information about that book. When I get to a point where I think people can handle new information about the book, I'll share a little bit here, a little bit there, just to keep people rethinking their thinking. The book is incredibly deep. The first time you thumb through it, it seems like a scattered buckshot of ideas. And it really all comes back to one idea, and they're all intertwined. Like everything about that book is in a circle. It references itself so many times. So if you're reading it and it doesn't feel compelling, keep reading it. Like, I like find somebody who you can read it with and do kind of like I envision like a Bible study, but do like a study of this. Study the material, study it. Don't read it. Don't read it once over and then put it back on the shelf. Don't read it once every 3, 5 years like I did. Don't take 10 years to read it 4 times. Read it and read it and read it and try to apply. I'm not saying you have to rush out and get a policy in place, but try and see the concepts he's talking about. Um, Man, that'll be banking. Once you have an understanding there, all his books really, Warehouse of Wealth. He references a lot. There's a lot with the Bible in that one. How privatized banking works. Like he references the history, like we're talking about. Um, yeah, actually, I have. Let me pull this up real quick.
Yeah, pull up what you want. He's also got a huge recommended reading list at the back of Becoming Your Own Banker. Like right now, I'm thinking about, oh, well, I could have said something about Ayn Rand's book, Atlas Shrugged, just to give people a big picture look at some of these large topics of banks or government overreach or inflation or the banking function or entrepreneurship and independence and autonomy, like big stuff. You know, that book in particular sticks out to me, and that's one of his recommended books as well.
Yeah, the case for IBC. He touches on a lot of those. There's a lot of good reading. He puts, like, I think it's on his website, but it's also in the back of all of his books. He has different books to read about. Manias, Panics, and Crashes. Is that it? I think that might be it. Manias, Panics, and Crashes. I think this is it. It's a history of financial crisis and what governments do in light of those crises, including step on everyone's rights and like confiscate things, what they look to confiscate, what rights they look to take away from you. And it's not one country. I believe it goes through tons of historical examples over different countries. It just people with power seek to maintain that power, and they follow a predictable pattern. Um, and frankly, what you can do with a whole life policy threatens that. That's why I believe there's a lot of restrictions on this. Whereas not too many restrictions on a Roth, not too many restrictions on a 401k. Yeah, they say here's a contribution limit and you just can't touch it till 59 and a half. But aside from that, there's nobody's over your shoulder making sure no one's looking at that like starving, like how do we get at this? They have a back door into it. It's an IRS plan. If they want to change the rules, they know they can just change the rules and take it. Countries have done it. They have confiscated retirement accounts. Um, that's part of what you agree to when you sign up and say, hey, we sign over everything for this little deduction this year. You could change the rules, you could change the tax rate, you could change the distribution rules, you could change everything about it. We just want the deduction this year. Um, so yeah, I agree with that. Study history, study what people with power do when that power is threatened, and then kind of apply it to your life. See what in your life you're doing. Like a good example might be take it off of both these topics. How about Bitcoin? Should Bitcoin have made the powers that be mad? Should it have made anyone mad if it really is just numbers on a computer? Why were they so mad? Because free people were contracting and exchanging goods and services outside of their purview? How dare them? It's like, oh man, it's just as prevalent today as it is, 100 years ago, 200 years ago, 300 years ago. It's people with power want to stay in power. Anything that takes away from that, oof, be very careful. They do not like that. They do not like to lose power or influence. I don't even think I think it's more that than it is money. I don't even think they care about the money. I need to be able to control. It's more about control.
Well, that I would say that satisfies me on the MEC. I hear where you're coming from, where you're talking about the big picture, and I see what you're saying in relation to taxes are going to be paid. So perhaps it's got a lower barrier for the powers that be. Let me ask this while I'm thinking about it. What type of annuity do you prefer?
What type of annuity do I prefer?
And I feel like I realized that I'm already recognizing that I could be asking a trick question because I feel like I know how I would answer that, but I'm asking you. So
For me, I think I would look for annuities that are like fixed annuities with some type of adjustment.
adjustment to what?
If I were going to buy an annuity, I'm on retirement's doorstep and I'm buying an annuity. I'm trading some capital for an income stream for the rest of my life. Now I realize the capital potentially could be passed on, whereas the income stream probably won't. Right? The income stream, whether I have a return of premium or period certain, we talked about that last time, but that guarantees the income will pay whether I'm here or not for X number of years. And if I'm not, either the income will continue or they just say, we would owe you X amount. We're just going to give that to your beneficiary. So I would choose that type of annuity with a return of premium, but the benefit could have the potential to increase over time. So one comes to mind. I know there's several coming out now. The original, I believe, was with Northwestern Mutual, where they had a fixed annuity that had access to the general account, so it would declare dividends. And so just like a life insurance company, where the death benefit increases over time, the actual income plan, the income benefit would increase over time. So it kind of, sort of gives you some type of hedge, you could say, against increasing costs in your life. Those are probably my, like, I don't need the like, I actually, if I had money in the market, I think a variable income plan would be my second choice. And maybe having them kind of layered together, where some portion of it is just a variable income plan. So the income benefit increases as the underlying investments, like maybe the S&P 500, as a simple example. As the S&P 500 rises, the income from that portion, that annuity, increases. As it decreases, though, the benefit would decrease over those years. The primary benefit would be you're not actually selling, though, to get the income. So as it recovers, your benefit would recover just as fast. Whereas if this was a portfolio that someone had to sell to get the income because they're living, they need to live, you'd be selling at depressed prices, which has a massive, massive negative consequence. The selling in a down market means you have to increase more than what you received to get back to even.
All right, so I think everybody should listen to what you just said, rewind 30, 60 seconds, and listen to that again. Because I'm sitting here listening to that, never having thought through that before, that relationship that you're describing. So it makes me want to say it in my own words to make sure that I am on track here. What I'm hearing you say is that if capital were just purely placed in the market and the market experiences a downturn, the principal has experienced a different kind of loss than if that same capital had been put in a variable annuity, let's say. Yes, you'll earn more.
Variable annuity plan, or in the income phase.
Correct. Yep. That's what. All right. So thank you for making me say that. That was what I was thinking. Versus the capital that had been originally placed in a variable annuity plan that you're receiving the income from already. You're in the annuitization phase. There's that principal is still paid to the insurance company. It didn't experience a loss. Yes, you received less income, but it's not like anything evaporated from what you did originally pay to the insurance company. That's how I'm.
Yeah, perfect.
Okay.
So like once you're in that income plan, you have a certain number of units. You never lose the units.
Right.
So the value of the units can go down, which is what the benefit is calculated off that value. But if the index goes up again, which, historically, if people are playing these gyrations, the gyrations swing one way, they swing the other way. So if that happens, if we hope that happens, and when it does, your benefit's restored or more than. Right? The benefit is more, it's like a point in time where you're starting. And as the index gets further and further away from that point in time, your benefit goes up and up. Right? You're picking, like, say, the S&P 500 at $5,000. As long as you're above that, your benefit has increased. If it ever dipped below that, your benefit would decrease. But as soon as it goes above it again, it still increases. Like you never suffer the sequence of return. You have completely taken that off the table. That's probably that's like, I'm reluctant to go there because it's a jargon way of saying it. But sequence of return risk only matters if there's income involved. That's on the way up, like heading to retirement, and you're putting money in, sequence matters. But if you're taking money out, sequence matters. And that's everything. Whether you're putting money in, You have a dividend, you have interest or capital gains, or like anything that changes the income, you add or subtract income, that sequence of return risk exists. I just said the units are the unit. There's no more sequence of return risk. You have it. You've converted for that amount. You're done.
So let's jump in real quick because that's one of those relationships, Joe, that I still remember strongly seeing it for the first time. I don't want to bypass what sequence of return means. So if somebody has $1 and they experience a 10% gain, they have $1.10, yes? And then if directly after that they experience a 10% loss, I should have done it the other way around because I can do that math in my head. You know, right. But if they've got the $101.10 and then they experience a 10% loss, they're going to lose 11 cents, which puts them at 99 cents, correct?
Yeah.
Right. So let's just say that 2 days had gone by. Day 1, they had 10% gain. Day 2, they had 10% loss. And we should maybe even say years just because that'll make it more impactful, I think, to people. You would think initially, it should be a wash. If I gain 10%, lose 10%, I should just be back to my dollar. But that's not mathematically how that relationship works. There is a loss monetarily, and then most importantly, I think, is there's a loss of the time. So those 2 days or 2 years, 2 decades, whatever you want to make it, right? That's always gone. Can't get that back for sure. Maybe the market would go up in a way to where you could get the money back. But loss of time, can't ever get it back. So sequence of return matters. I remember that's just one of those things when I saw that for the first time, I was like, what? Up 10%, down percent. How's that not, But then you pull your calculator out and you take your time and you're like, man. And then again, once you realize time, that's the one that nobody gets back.
So the different, what you're talking about is the different rates. So people have a average rate compared to your real rate. There's internal rates, there's time weighted rates, there's dollar rates. So they created all these rates of return to try and measure this, because it gets really weird when the thing we're using, $1, changes value over time. So it's generally going like this. And then that thing is exchanged into something else denominated in that thing going like this, in hopes that it goes like this. And then it's happening over periods of time. And they're trying to imagine trying to shoot a gun at this thing that's like, like Duck Hunt in Nintendo.
That's exactly what I was thinking. I was exactly thinking about that.
That's what they're trying to do with this rate of return. Like, God, this is the rate of return that works. Yeah, that's a really interesting study to look at how they measure rates of return and the different rates that come out over time with different orders and things like that. The sequence of return would mean, okay, let's take that and say up 10, down 10, up 10, down 10, up 10, down 10. So pick your numbers, positive and negative, for 20 years. If you reverse those numbers over 20 years, the same starting balance, so we're just taking the rates of return and just putting them in the opposite order, you'll get with the same return. You'll have the same balance at the end. The sequence of return, that risk exists when we add money in. Right? When we add to the pile, depending on when we add and what happens after we add, the balance will be very, very different. That's the sequence of return where I'm saying, if you pull money out of the pile, man, you really got to worry what's going to happen the next 10 years in this order of returns. Pick your rate of return. I don't even care which version you're using. The order, though, really comes into play when you take money out or put money in.
That's what really burns me up about folks who will say, well, the only time you get hurt on a roller coaster is if you jump out. Just ride through the downturn, they'll say, right? Well, what if somebody's actual real life timeline is, well, they're ready to retire and they're in the bottom of this devastating trough. where they're ready to actually be receiving income from wherever it is that they've put money, and it's at that super low. Well, if you start taking money at that time, it's like woe upon woe right there, you know?
And modern financial planning doesn't really have an answer. Their answer is just stay on the roller coaster. Hope that roller coaster comes back up. Hopefully you have money somewhere else. Don't take it out of this. Take it out of your home equity. Take it out of, saving. Ironically, they'll say, do you have any life insurance? Man, that would be really good to help us put our existing pile of junk on life support. Can we use that to help let that go back? At the end of the day, it's the most certain. Anyway, I don't.
Well, I'll say this. I mean that actually would be a boon, though. Is the thing is, in that case, I see exactly what you're saying, and we've talked about this before. But it's so interesting, like you said, that somebody with any wherewithal could say, well, hey, do you have any life insurance that has a cash value that you could have access to? That way we could weather the storm. I love your analogy of put the conventional financial plan on life support. That's really good. I really like that. But actually that would be a better case scenario than somebody who had done conventional finance. Their initial plans are needing to be put on life support, but they don't have access to capital, in policies that might not even be optimally designed, of course. The cash value could have been better, etc., so that they could at least put it on life support if they wanted to put it on life support. That's actually a better case scenario if somebody did have it. But then, of course, knowing what we know about life insurance, we're going to say, well, no, let's start with that. Let's start with the foundation of, financial independence and freedom. And then you diversify however you want and put things on life support or augment or scale or, because I think everybody should do what they want to do. But yeah, life support. I love it.
I think the crux of that is start your foundation that's most flexible for you, that offers you the most certainty in the simplest way possible. From there, then sure, you want to go put your money somewhere where you can't get it back. Sure. If you're hell bent on doing that, go ahead. You will be better off for doing it in this order. And that includes an annuity, which I was going to talk about. I don't know if you still have time here, but the idea of what's my favorite, you asked me, and when would I take it might be the next logical question. When would I want to buy an annuity? I think for me, because life insurance is such a huge component for me, would be to use life insurance in the same banking capacity, not planning to take income from my life insurance, at least not at first. I would look at an annuity like I bought a rental property that's just going to pay me with no headaches, right? There's no tenants, there's no lease, there's no cleaning, there's nothing. There's no depreciation in the property, there's no painting, none of it. It just pays. Instead of saying something we talked about, you could 1035 part of the life insurance to create the annuity. That's not what I would do. And I wouldn't take a withdrawal from the life insurance to buy them. I would literally, just as if you were buying, a truck and took a loan to buy the truck, I would buy an annuity with a loan, keeping the life insurance and all of the old PUAs and all the dividends within the policy still growing. Keeping the policy growing at the current increasing rate that it's on. I would use the annuity to then create the income to live off of, and maybe pay back part of the loan if I didn't need to live off it anymore. There's some math there to triangulate, like how much of an annuity would you get? How much did you want? How much could you what's the interest on that loan to make sure the annuity could pay that interest plus the lifestyle goal that your cash flow goal that you're trying to create. Now, the problem with it is annuities during the distribution phase eventually become taxable, right? So there's an exclusion ratio to say if you bought an annuity for, I don't know, $10,000 a month or something like that in retirement, so it's like $120,000 a year, maybe two-thirds of that or three-quarters of it would be a return of your original premium, so not taxable, but 25% would be taxed as ordinary income. So there's a difference that you have to pay attention to in taking from your life insurance, which is not taxable. This would be a taxable event, an annuity. Eventually, you would receive all of your basis back. You would receive the original amount back, in which case the exclusion ratio is it's all taxable from that point forward. So at some point, the annuity, if you live to 150 years old, like it will be, everything you receive will be taxable under current law. Now that might change and there might be new rules. And so it's worth noting you could, there's several ways to skin the cat. And I think preserving the foundation to the best of your ability, which gives you the most, optionality, is a key thing that I really harp on. I want to maintain the control for my whole life. Because once you pull certain levers, you can't unpull them. And once you pull them, even if you push them back, the result is going to be very different than if you had not pulled them. And I think Nelson talks about this where he, one of his earlier policies, his brother sold it to him. And he implemented something called premium offset, where he used the dividend and maybe part of the paid up addition. He said, take that in some combination to pay the premium because I don't want to pay anymore. So he was using the policy values to offset his premium, so he didn't need to pay anymore. And he did that for several years until much later he realized the benefit of paying premium and having the values continue to increase and having the dividends purchase more death benefit, where he reverted. But just because he pushed the lever back and started paying premium again doesn't mean he got all that value. He lost the value over that time period. You can't go back in time and get that. And you can't go back in time to make the purchases when he should have made the purchases to get the dividends and the growth that he would have gotten if he had just done it correctly the first time. But you live and learn. He still had an incredible system and was able to achieve financial freedom and never have to go to a bank in 13, 30, 40 years after he slayed the dragons. Yeah, that's just to say, if I can avoid making one of those choices with the life insurance, the core foundation, then I will. Even though it might cause a little bit of taxes later via annuity income versus an insurance contract, distribution or loans. There's even a strategy, which we're getting real nerdy now, where you can combine the two, where if you had an annuity, even for 20 years, you're targeting a 20-year time period to allow all of your policy, your whole system, to continue to increase in value for 20 additional years before you start taking dividends and distributions. Look at what happens when you're 80 instead of taking distributions at 60. The dividends and the whole contract is much, much larger. So you can use both of them in conjunction to have more spendable dollars on a more guaranteed and certain basis over the course of your life. And that certainty addresses one of the core problems modern financial planning doesn't, which is the future is unknown and preferences change. Um, that's such a huge, like, if you're funding something else besides an insurance contract, and you decide to change your mind, go start a business, go on vacation, change career, like, the amount of penalties and hoops you have to jump through to get your capital back, it's shocking. Because it's really a 401k is a kind of trust agreement. An IRA is a trust agreement where there's a custodian looking over your asset, not really doing anything with it, just preventing you from getting it. That's their job. For you to get your capital back out of that, trust, so to speak, man, it's really tough. And on the way out, they slap you with fees and fines and taxes, and not the best situation. If you want the freedom to change your mind, not the best situation. If you believe the future is unknown and you have no idea what awesome opportunities are around the corner. If the best opportunity is not in your 401k, but all your capital is stuck in your 401k, what do? You could have the chance of a lifetime. If you can't get your hands on the capital, it dies on the vine. It's gone. You can't capture it in the lifetime of the opportunity, lifetime of the chance. The amount of certainty and flexibility with IBC and whole life as the foundation gives you speed. The speed at which you can execute things, it's remarkable when certainty is on your side, when the contract is for you, not against you. The next best thing is probably an annuity. Like the only thing, the characteristics we're missing are also kind of a benefit, because that means we don't have these MEC limits looming over. We're free to put a lot more capital into this. Yeah, those two together, there's a reason why they're mirror images. And I think the first being life insurance, if that's your foundation, you have a really powerful combination with just that and an annuity. The things you can accomplish in your life are remarkable that you just can't otherwise.
Well, let me ask you then, paint a picture for me where, let's say, and we can try and add some different pictures to case studies here. All right, just some potential scenarios. All right, so let's say there's a career individual, right? They've got a W-2, they're pursuing their career, and let's say on the home front, they've implemented infinite banking to pay off debt. And let's say they're out of debt, and now they've even used a system of policies to build a long range emergency fund. Okay, so let's say we're talking about the kind of individual who doesn't have consumer debt. They've got exigent funds built up in a system of policies. They're obviously making great steps towards legacy as well by having death benefit. If they have, 2, 3, however many policies, but I'm just trying to paint you a picture here. And let's say they're actively financing future purchases now too, in this, even a small system, 2 policies, 3 policies. When might it make sense for that person to consider getting an annuity? Is it an age? Is it, what is it? Or what could it be? I'm not trying to pinpoint you to one thing. I understand, obviously, looking at case by case scenario, and that's why I said career person instead of a business person, because I'm getting ready, because that'll be the next scenario that I'll maybe ask you about. But what occurs to you there?
Yeah, I think the career person, remember the contract, a deferred annuity or a deferred annuity that's still in the accumulation phase can become an income annuity. So if you have the right contract that allows you to annuitize to the full portfolio of income plans, you could start that tomorrow. There's no, like, read the fine print. They might say you need to put $500 or $1,000 into this thing to lock in the mortality, to lock in the conversion feature, we'll call it conversion feature, the annuitization feature of the income. But yeah, why not? This is now a place for windfalls, excess windfalls. If you don't have enough room in your banking system, you've maxed out your insurability. You know, where else could you put capital that would have this monster secondary benefit? It creates the income, which allows the other system to continue to grow for 5, 10, 20 years. So the death benefit and the cash values and the dividends are all increasing over here. Um, yeah, I think you can get started early. I think when you convert, yeah, that's a conversation for the person. When you convert, when we annuitize, I think that should be with your advisor. That should be planning out your cash flows and saying, when do we think other cash flows disappearing that this needs to fill in the gap for X amount of time or my whole life? Like this would be a working conversation you'd have with your advisor.
Of course. Well, could it be the case that a 55-year-old decides, I want to work 10 more years, so I'll start an annuity where I anticipate paying a certain amount over the next 10 years because at 65 I want to be able to walk away from this career and come what may with it, because I still have hopes or aspirations, or maybe I'm still doing other things, right? Have other investments or etc. But that's part of my plan, to where I expect to trade that active income for this passive income.
Sure. Yeah, that works. And again, you just have to be very careful. You're getting into like what type of annuity you have and what the contract says and what, for example, a lot of deferred annuities will typically be variable annuities. There are fees involved there. So all of this should be fleshed out. You should have a deep understanding of this before you just don't go online after hearing this and go click the first annuity you see that sounds the flashiest. You really got to understand what you're getting into. What are all the exit strategies? If you need to get out of it, if you need, this isn't what you wanted to do, where's your flexibility and control? How far does that take you? If there is none, or by using any of these rights, does that kill other things in the contract? You need to be aware of all of that. So first, know the contract, but yeah, talk with your advisor. Have a really good understanding and plan for this. Have a purpose behind it, and it's designed to fill those purposes.
Yeah, work with a quality individual like Joseph DeFazio from 10th Street Capital.
Or Jesse Durham from Durham Talents.
Okay. Well, yeah, no, I was definitely trying to speak in generalities just to paint some kind of a picture. So I appreciate that you answered my question about when should someone consider implementing an annuity. And I did try and use a career person right there first, because obviously I could take that same person who, if they've implemented infinite banking, paid off debts, built an emergency fund, and they have a business, then of course that person is probably if they're still in the active business building mode and they're not today ready to retire, they might have a certain plan. Well, yeah, I want to have an annuity because I want that to be part of my exit strategy from, actively building the business. And who knows, if they're like us, they might be more the mindset of, no, retirement is a curse word. And, yes, I want to set up passive income. Yes, I want to have, these beautiful types of contracts that are available from these insurance companies in these annuities and these life insurance policies. But no, I anticipate, building the business in perpetuity until the Lord calls me home. They might be in that train of thought as well. Is there anything though that you would say different for a business owner? I guess I wonder, like I always look at the world in these types of filters, the Robert Kiyosaki filter comes to mind of, career individual employee versus say a self-employed person versus a big business person who's, managing some 500 employees plus,
So I would say yes. Oh man. Um, I think depending where they're at in their psychology, if they're just building their business, they could think just like you would say a policy, a life insurance policy. A second one is like a branch office. They're expanding their banking business. They could be thinking, it's another rental property. I'm buying another rental property. They could think that way. Um, Time limit, I don't know. I don't know that there would be one. Business owners have this, whether it's contracted, small or big, like you're saying, have the benefit of seeing 100% of the revenue. They have this incredible benefit that all of that money's in their hands first. So where they put it could then really change their future much faster than like a W-2 person, because you're getting everything after the tax man got theirs. You're getting 75% of what you actually make. You're getting 60, you're getting 80% of what you actually make. That 20 hurts. That 25 really hurts. And it's to the benefit of the business owner because they have the option to, if they saw the benefit of controlling capital, they can pay fines to say, I don't want to pay quarterly, or penalties, you could call them. I don't want to pay the quarterly installments. I'll just stir up at the end of the year. So they have all of their revenue all year long, control of it. There's some really cool planning you could do there. Now, I think a business owner psychology in the growth phase is going to have a challenge with an annuity specifically, because annuity, like we said, we can't collateralize. So once the money goes there, it's going there for an income purpose in the future. For them, the return on equity or the return on capital is highest probably in their business, or if they have a mature banking business that's financing their business, right? That combination is off the chart better than anything else. There's nothing else like it. Sorry. No stock, no nothing. Like, unless you're the IPO of something that's going public like crazy, bajillions of dollars, you're not going to get it in the S&P 500. Sorry. That combination will dwarf like just about anything else. So to take away from that to go buy an annuity, they would they would need to be really forward thinking. To say, I know at some point there's going to be a succession plan. Whether I keel over in the middle of my work day when I'm 99 years old, or it's actually planned. I'm like, hey, I want to pass this on so I can be more consultative for the next generation. So I bring them up for 10 or 20 years. So then when I'm gone, they know how to run this thing. And maybe they're more forward thinking, legacy related. They could still work, but it's not the same capacity. Then they could start thinking, okay, then we collectively could use the cash flows of the business to buy an annuity to pay me the difference while you're earning the profit. Like, it becomes more fun. It becomes more like, as long as their mindset's open and not just my business must grow. If they're in that mindset, stay away from an annuity. You're not going to like it. You're not going to like that you lost control. You're not going to like that you have to wait. You're not going to like any of that. Stick with IBC whole, like Nelson in his book, Building Your Warehouse. I think it's chapter 10. I think it's chapter 10. It's all about annuities. And he's like, why? That's a terrible place to warehouse wealth. For banking purposes, absolutely. If you want to get your hands back on it, absolutely. But an annuity's purpose is income generation. So if you hear yourself saying, I need cash flow, or I would do this, but I don't have the cash flow, an annuity you might want to add an annuity into the conversation as an option, including, like I just said, if someone's taking a step down, obviously you can't support two owners' salaries. So the old owner would have to deliberately take a lower salary or draw from the business to allow the next person coming up. Like, it would have to, like, they'd be bought out. Well, maybe part of that buyout is to get an annuity at the end of the buyout that then gives them a floor on top of maybe their Social Security or whatever else they have going on of a lifestyle. So there's a lot of cool planning you can do. but they have to be open-minded. Both, whether the employee or the business owner, a big, small contractor, everyone has to be open-minded. If you're cynical and closed-minded, this is not going to make sense. An annuity is not going to make sense. Life insurance is not going to make sense. Banking is not going to make sense. Just stay with the S&P 500. I'm sure you're fine.
Cool. Well, right there, close to the end, you tackled two questions that I definitely wanted to get to, which was, well, what did Nelson think or say about annuities, and what would your response be to that? And then the other was, I just wanted you to be able to give, a recap on anything that you want to, but the pros and cons of annuity this, annuity that, because earlier you said, for example, and I love the rental property analogy. It's like a rental property without toilets, without tenants, without, it's just that's a huge advantage for somebody, especially that values that type of low rub, low friction. It's just going to be this way. And then that is offset with, the inability to collateralize it. So there are those pros or cons. So anything that you would do there to wrap up saying, well, Nelson said this, and that's a point, and here's my perspective, and here are the pros and the cons.
Yeah, no. I think like the main point is if you need access and control, and an annuity is not the place. So why would you do that? You would go with the life insurance. And I think at the end of that chapter, it even says one great use would be an immediate annuity. Remember, that's like we're starting the income as soon as possible, as soon as they'll let us. You would start with your whole life first, and then from there buy the annuity, just like any other investment. Kind of like what I was saying. Like I think, he was in favor of that, but not in favor of trading any part of the life insurance for it. Treat it just like you bought a rental.
So are you saying, let's say somebody had a mature policy, they had $100,000 in cash value, they took a policy loan, they started an immediate annuity, which would then kick off a stream of cash flow to them after that. Is that what you're describing?
Yeah. Yep.
Okay. So then my question then is, well, what if they then took that distribution and paid premium, whether into an existing policy or a new policy?
Yeah, I think remember it's actuarial science, so there's a little bit of a drag because there's mortality costs involved. It wouldn't you could buy another policy, but you probably if you remove the annuity and just took a loan to do that, you could do that, and you would have more to buy the next policy than if you did it the other way. Adding the extra step, it's like it takes a little bit off of the income stream, and then that income stream buys a smaller, is smaller for the premium, and the death benefit you'll find is very close to the original amount that you purchased the annuity for. Start that way anyway. So in time, if you live a long, lovely life, yeah, that life insurance will get larger and larger and larger compared to the original. Am I explaining that right? So if I took, let's say, $50,000 of your example and bought an annuity for $50,000, the income it would produce could buy a life insurance policy that had a death benefit of about $50,000. So right away, it kind of looks like a wash. But given enough time, that policy will go from 50 to 55 to 60, 70, maybe 100, maybe 150. Given enough time, and then the annuity will just keep pumping out the premium. Boom, boom. So it's a long-term plan. Nothing wrong with that. Like this could be a great example of if you took a joint annuity to pay premium for a child or grandchild, long-term plan. Yeah, that or another generation, even one generation below, you'll get more death benefit for the premium dollars. So yeah, it's kind of a little bit of a matrix hack there.
We're in the deep waters, man. It's very interesting. I think we've covered, resources. I appreciate the book that you mentioned earlier.
And you've brought in, Nelson, all of Nelson's works, Becoming Your Own Banker, Building Your Warehouse of Wealth, the case for IBC, how privatized banking really works. I still strongly recommend Atlas Shrugged as well, and all of Nelson's other recommended readings. We covered the MEC. You gave some insight into your preference of annuity, which is just interesting to have. Every case is individual, though. We said, of course. I want to revisit Building Your Warehouse of Wealth yet again. I would even say, when we were talking about Becoming Your Own Banker earlier, that's one of the benefits for me in having done, and I'm about to finish my last installment, Joe, into my book review series that I have on the channel on the Becoming Your Own Banker book, because it's a structured way for me to, on camera, go back through the book and discuss it out loud. And then, I'm actually actively implementing that saying of when one teaches, or is it, yeah, when one teaches to learn. Yeah, it's helpful for me to revisit it in that way. I hope that makes sense. I've gained from having done a book review, is what I'm saying, because it actively put me back in the book on purpose, which I love. I think you've exhausted all of the questions that I had written down. How would you like to wrap up the discussion on annuities? Your thoughts, independently and in connection with infinite banking.
Yeah, I think if we just consider mindset first, if you're buying this as a product, I mean, we didn't go down how to properly assess an annuity, or anything like that, but just keep an open mind and be aware of what purpose it serves and the problem you're trying to solve. It's really easy to get pulled in different directions of this is flashy and that's flashy. Oh, but this has this many more, benefits in this regard. It's just be very careful and judicious as you go through the contract. What's guaranteed? What is certain? What is not? Which of those columns matters more? And like we said, it's not as flexible as whole life, but realize you're probably going to change your mind over your life. If you're buying an annuity, for example, when you're 20, which, very cool to be that forward thinking. But the features you're going to look at right now when you're 20, probably very different than when you're 60, very different when you're 80. Try to think through. It's really hard, but try and put yourself in those shoes. Like if I'm super, I'm just getting my first real, job or career off the ground or business off the ground versus I'm mature in my business and it's growing, it's doing great versus I've got to find a plan to exit my business or pass it on to someone else versus I'm healthy and in retirement versus health wanes. Now everything's about health care. Put yourself in those shoes to consider what matters most, because this is a contract for your life, your whole life. And I'll give you a hint. Most people go for the rate of return column when they're really, really young. You can't spend rate of return. Most people think rate of return implies more spendable dollars. It doesn't. Make sure you actually get what you want for the purpose that you want it for. I guess that's the most generic way I can put that. When you're trying to assess whether it's life insurance or an annuity, an insurance contract, make sure you're playing this out over all of those different phases in life. It's something transferable to the next generation. Is that important to me? Will that be important to me? Do I want the option to make it important to me later? Like think through this. Don't jump at, oh, that's got a 10% guarantee. Woohoo. 10% might be a lot right now or when you're 20. We don't know. We don't know what things are going to happen in the future, or what that might not be that much. It might not be spendable later. There might be new laws that come out, like the MEC laws that changed everything. Just, you got to think. You got to think through things and have somebody willing to challenge you on the same side of the table, but just willing to point out things you may not have considered. Like Jesse. Talk to Jesse, man. Get on the phone with Jesse. Yeah, I guess that's all. I think between the two concepts, whether it's IBC, using whole life to implement IBC, process, product, and the product of an annuity for the purpose of generating income, keep an open mind. Stay curious. You can have a healthy skepticism, but stay curious, stay open-minded.
Man, thank you so much for fielding this conversation with me. And I'm glad that we were able to make it a 2-part so that I could just have some time. I've really been thinking through and revisiting my notes from last time to this time. And I think we might even do what you suggested just in our private conversation and bring the topic of annuities to our roundtable in the future as well. It'd be neat to hear other people's stories and perspectives, and hey, this is where I'm at, because there are so many different individuals that are there, and then we help so many different people in our clients as well at the same time. So neat, man. I appreciate you. First and foremost for myself, because this has been on my radar and I wanted to have a discussion, and I'm very glad that it was with you, and I appreciate you.
Thank you, man. Happy to be here anytime.
Awesome. Well, that was an absolute blast for me. I've had some technical issues, so I'm getting this to you here to say, if you have any further questions around the subject, put those in the comments below so that we could address those. You can find Joe's contact information in the show notes. You can find me at durhamtalents.com. Live and leave a lasting legacy. If this video was valuable to you, make sure to let me know with a thumbs up, and I'll see you at durhamtalents.com. Live and leave a lasting legacy.